Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in this video I'm going to talk about one of the best dividend paying ETFs out there. This is not a Sharia compliant ETF, but there are loads of stocks in there that are Sharia compliant. So what I'm going to do is I'm going to give you 10 different companies that are inside that ETF that are Sharia compliant, and I'm going to give you the information about each one of the individual stocks. Then we will look at how these companies have performed. So if you build a portfolio of just those 10 companies for the last 25 years, what would be your total return? So if you invested £10,000, how much would you be how much would you have right now? I love doing that because back testing is probably one of the best things that you can do to kind of have an idea of potentially what you might end up with in the next whatever years, right? Again, it kind of gives us an idea, but it's not, of course, going in like the past is not going to tell us what's going to happen in the future. Anything can happen, anything can change quickly. But what we want to see is where have they been, and potentially if they carry on more or less same trajectory, will this be, will this some of these companies perform the same way and so on. So it just kind of gives us an idea. So we'll do that inshallah towards the end of the video. But you might be wondering why on earth basically I have not said anything about what's happening in the stock market today, and I'm going to talk about it today because, as you know, the stocks are down a lot today, especially if you are Nvidia, if you are Broadcom. Broadcom is one of the companies I own. It's down over $200 per share today. Okay, and I do own, I think, about 50 shares of this company. So because of that, my portfolio is down quite a lot. Another company that is down a lot today, 60% is Nvidia. We've got AMD, just about 6%. Actually, 6% is not bad for today. You've got other companies, for example, AMAT or Applied Materials, Lam Research, and KLAs, and all of them down. And in fact, let's just have a look full. Potentially, we can see TSMC as well is down about 16%. You might be wondering what on earth is happening here. And it's really simple. This is another way of basically one of those days where basically, when it comes to Wall Street, basically overreacting, something that is happening with basically the world of AI. AI has basically more or less kind of revolutionized in the last couple of, I wouldn't say revolutionized, but changed the game for a lot of people because of ChatGPT and what is capable. And what's happened now is China came up with a new software or new basically ChatGPT that looks like a ChatGPT, acts like ChatGPT, called DeepSeek. And what is happening since then is basically Nvidia is down about almost 17%. And one of the things that I've noticed is basically one of the main reasons it's down is because they said we can actually do, okay, basically since they started, they only spent about 6 million, okay, just 6 million to actually do everything we're doing so far, okay, which is absolutely crazy because if you think about it, last week OpenAI joined a group of other firms who pledged to invest $500 billion in building AI infrastructure in the US. And remember when Donald Trump was basically talking to these big boys and from the OpenAI and all the other companies, and these guys came along and say, you know what? We basically used, okay, around 6 million, 5.5, I think was about 6 million US dollars to actually make this thing. And if you know anything, you will know that basically when it comes to the cost of building these AI models and so on is very important because a lot of people are building those, data infrastructures, the AI infrastructures, data centers, whatever. And they cost a lot of money. And these guys are saying, you know what, we only did it with 6 million. Now, if you read the article, I've started reading about it, so I can't be bothered to finish it tonight. But there was an article that they basically, because it's, by the way, this is what's called open source. In the world of tech, open source means anybody can have access to the documentations and source code and a lot of things, right? So they definitely copied more or less ChatGPT, what they've done, but there's open source and you can see a lot of the information. However, this 6 million is probably more, is more to do with one part of the whole development rather than the data side of things. There's quite a few things that they mentioned that they have not included in this cost. So it will be interesting to see. So yeah, because there's a lot of noise going on with that situation today, and of course all of these big boys have been betting on the fact that the OpenAI will be the leading company and so on. All of a sudden, this company comes in and said, "Oh, by the way, we did all of that for with basically with less than $6 million." We will see. They could be lying, and basically people have said, "Oh yeah, China are not telling the truth, or we don't know the full facts." Open source, let's see what happens. I'm sure we'll get to the bottom of it. But in the end of the day, that doesn't mean anything for me. I am down about £1,200, but that's about just 1% of the entire portfolio. There is a lot of companies that I own today that are actually up so much, including Salesforce, which is actually benefiting from all this. So it's about 5% up. There's a lot of other companies, for example, in the healthcare side of things. Merck is actually, Procter & Gamble is up. Home Depot was up about 2% not long ago. So there's so many, including even UPS. So this is why I always advocate for having a diversified portfolio. And genuinely, honestly, guys, no matter what you do, do not just buy one sector. Do not just rely on these high flyers. Don't buy in basically £10,000, £20,000 of Nvidia when your entire portfolio is £30,000. Make sure you're very well diversified, because anything like this can happen, and when it happens, you're just gonna lose a lot of money. And some people actually get out the market because of that. If you own today this company, Arista Networks, for example, you'll be down 18%. I'm down 16-17% for 1B1 in stock. But guess what? I'm up actually more or less the same with other companies, right? So you're gonna really have to have a portfolio that is well diversified. Now let's talk about the ETF that we came here for today, and that's Vanguard High Dividend Yield Index Fund ETF. This is not Sharia compliant, like I said at the beginning, but there are companies in there that, the top 20 that are basically 10 companies are in there that are currently. So what we're going to do now is look at the 10 companies. I'll give you brief information and then each one of them, and then at the end I'm going to show you, like I said, the entire portfolio. I'm going to show you guys how they have performed over the last 10 years and 5 years, sorry. And the first one is actually Broadcom. Okay, before I actually show basically the rest of them, this is the ETF that we're talking about, and it has a dividend yield of 2.6. Okay, now if this was a Sharia compliant ETF, I genuinely promise you, I will not be buying anything else other than this ETF. I will buy this weekly. Okay, and there's another ETF that I'm going to talk about next week as well, in the next video, inshallah. Between those two, probably be my 60, 70, 80% of my entire portfolio. The rest of them, I might just buy a couple of individual stocks, because that 2.6 to 3% dividend yield is what I'm normally looking for. And the fact that, look at the expense ratio, 0.06. I wish this was Sharia compliant. I wish Vanguard starts doing something like that for us, because that will actually make a huge difference. And inshallah, the day will come. We just have to be patient enough. We've seen the markets change with regards to ETFs, inshallah, in the long run, that pay dividends. And right now, the ones that are out there, they're not really great when it comes to dividend or even performance. But there are some really good ones, that like the ones that I have in the portfolio and the ones that we've talked about. If you're interested in Sharia compliant ETFs, just click the playlist for the ETFs. There's plenty in there. As you can see, this company at the time of recording was 1.1. I'm sure it has dropped at the time of basically putting the video together. So right now, probably less than 1 trillion. Moat is basically white moat price right now $203 per share. Now it's probably about 15% cheaper than actually when I put the video together, so you can subtract that from whatever. But overall, this company is really great, but the dividend is not there. Okay, the dividend, remember, about 4 years ago when I started buying this company, guess what, this dividend was over 3%. It was about 3-something%, and since then it actually dropped because of course the price has gone up so much. The payout ratio is very low. The latest increase is 11% and the 14% in terms of the 5-year growth rate, which is absolutely amazing. 14 years of increase in that dividend. $2.36 is what you get. 67% in terms of safety. In terms of profitability and side of things, is absolutely fine. Management doing good job with that. Free cash flow is absolutely amazing. Total return the last 10 years, we're looking at about 38%. They're expecting to grow earnings basically massively. Let's see what happens with this AI craziness that's happening. That might actually basically make things difficult for this company, but overall it's a great company. Like I've always said to you guys, it's probably one of the best buys that I've ever made. The next one is Procter & Gamble. Like I said, I'm going to give you very brief information. You can do a little bit more research about each one of the companies. Next one is Procter & Gamble. We've talked about this company a lot. I own in portfolio. You get 2.4% in terms of dividend yield. It's very, very safe. 68 years of increase in that dividend. Remember that a lot of things has happened over those last 60 something years, but this company continued to increase that dividend. This is why I like this type of businesses, because they spit out so much cash, and they have so much cash they give it back to their customers, basically shareholders. And one of the things I love about this, you will never see this company going down 16-17% unless something crazy has happened, and they're not that volatile. And I really like that. I can sleep well at night knowing that majority of my investment is in this type of business. Okay, the difference between these two in terms of beta, it's absolutely ridiculous. Okay, so overall, very, very profitable business. They have excellent free cash flow. They're growing nicely, and they are a little bit expensive right now. The next one is Home Depot, another one I own in my portfolio. $386 per share. They're reporting, I think, towards the end of February. This company is probably one of the best companies that I've owned in my portfolio. I wish I bought more when I first started. Okay, right. Last year it hasn't done much, but I'm expecting a lot more because of interest rates coming down. Potentially, people will start renovating their houses and so on, and the prices, basically, the stock price will rise with the revenue growing. InshaAllah, 2.3 is basically what you get for dividend side of things. It's very, very safe. They have been increasing it for the last basically 15 years, and of course, in terms of profitability side of it, absolutely amazing. Really excellent free cash flow. Total return is decent, really good for this type of business. And then when it comes to EPS revenue, it's expected about 4% or so to grow. Really expensive right now, $290, basically $2 per share is where they think the price should be. Next one is Abbott Laboratories. This is another basically a pharmaceutical company, 217 billion market cap, narrow moat. In terms of dividend side of the 1.8, so almost 2%, which is really good. Dividend king because they have increased it over 50 years, so very safe that dividend is. Profitability is side of things, the management doing a good job. Free cash flow right now $6 billion. Total return the last 10 years we're looking at about 16%. EPS 10% for basically expecting next year, 7% after that, 15% premium right now. $109 per share is where they think the price should be. The next one is Qualcomm. Another one that I own in my portfolio, probably one of the best out there. I completely disagree with the fact that this company has a narrow moat. It should be wide moat because of the patent that they have. Really like the company, almost 2% in terms of dividend yield. In terms of the payout ratio, very, very low. Increase that dividend for 21 years. 4 more years, it will become a dividend aristocrat. Very safe. Profitability, management, basically effectiveness is really good. $11 billion of free cash flow right now. Total return the last 10 years. That is not true. I wish that was true, actually. We can double check that. And we're going to check Morningstar. So there you go. That's about, let's call it about 11%. So it's not that. So it's about 11%. We'll change that to 11 for now. Okay. EPS, we're looking about 9%, expected to grow about next year, 7% fairly value right now, basically $8 per share is where they think the price should be. And as you can see right now, just about 107, so about 70. So it's about $10 slightly lower than where they think the price, basically the fair value is. So it's really good. If we see maybe a massive pullback in the markets, I'll probably start again buying this company, because it genuinely, I don't think I will ever sell this company, I promise you. Texas Instrument, another one that basically is in the semiconductor company. They do specialize in the analog side of things. 190 billion market cap, wide mode. In terms of dividend, we're looking about basically 2.9. Now this is the issue for this company. The payout ratio is very, very high. You do never want to see this. Okay, latest increase, because that means basically over 101% of their net income they invest, basically they're giving it back to shareholders as a form of dividends, which is ridiculous, right? Rather than cut the dividends, they actually do something. So we'll see what happens when they report. I think they're reporting maybe this week, next week. So when they report, we'll see what happens. Or have they already reported? I can't remember. Anyway, the 5-year growth rate is 10%. 21 years, of course, increasing that dividend. Annually, you get $5.40. Very, very safe. And basically, with regards to return on invested capital, profit margins, return on equity, absolutely amazing. But free cash flow $1.5 billion. That's probably why they haven't actually cut anything because they do have enough cash and so on. Total return the last 10 years, we're looking at about 15%. EPS is expected to grow about 32%, is one of the highest on this list, which is very interesting. And revenue is expected to grow about 14%. Fairly value right now, $185 per share. So right now it doesn't have the momentum. I think the dividend situation or free cash flow needs to sort that out. Next one is UNP, or Union Pacific Corporation. This is a railroad. I do own the company in my portfolio. Currently has over 2% dividend yield. Very nice, very safe. It's been increasing for the last basically 18 years. Profitability, management effectiveness, really good. 5.8 billion in terms of free cash flow right now. They return about 9% to shareholders over the last 10 years. EPS is expected to grow about 12%. Revenue is about 5%, 14% premium, $222 per share is where they think the price should be. Next one is Eaton Corporation, another one that's been more or less sort of on my radar for quite some time, but I've never actually got the chance because it's always been expensive. You get 1% in terms of dividend yield, very safe in terms of safety, 85%. Profitability side of things, effectiveness of the management is absolutely fine. $3 billion of free cash flow. In terms of the total return the last 10 years, about 19%. They expected the earnings to grow about 11%, revenue about 7%. 35% premium, $274 per share is where they think it should be. The price should be right now is $315 per share. Another one that I own in the portfolio, and that's automatic data processing, 121 billion market cap. Now this is probably one of the best companies when it comes to dividend side of things, and effectiveness of the management and all of that stuff. Dividend, we're looking at over 2%. Basic payout ratio is very low. Well, not very low, but it's below the 61% that we normally consider safe. Latest increase was 10%, 50 years of increase, and so they another dividend king. 97% safety, which is really good. Management doing really good job. 5 billion of free cash flow right now. Total return the last 10 years for 14%. EPS expected to grow about 9%. Revenue about 6%. Fairly value right now, $280 per share is where they think the price should be. $299 is where it is at now. And final company today is basically UPS, or United Parcel Service. This is another one that I own in the portfolio. Again, I genuinely did not look at, I used to look at these basically the ETFs and pick those companies, whatever, but recently I've actually stopped doing that. I just did it all basically. I have my own screener that I use, but you'll think I actually went through the whole VYM and just basically bought everything that was Sharia compliant. But that's not, to be honest with you, that's not a bad idea either, but I wouldn't do it if I were you unless you know exactly how long you're going to invest, how much you're going to invest, the risk that you're taking, all the things that I had to do day and night and so on. So dividend right now is about 5%, which is very, very high for this company because the stock has gone down a lot. The 5-year growth rate of 12%, which is really good. 14 years of increase in that. 67% is basically the dividend safety. Profit margin, return equity, return invested capital is fine. $4.3 billion of free cash flow right now. Total return the last 10 years, 6%. And EPS expected to grow about 17%. And then revenue about 4%. I'm looking forward to this, inshallah. See what happens. Right now it's about 8% discounted. $145 per share is where they think the price should be. Right now it's $336 per share. Now let's quickly look at the next thing, and that is just to kind of backtrack. So we're looking at since 2000 to 2024. Okay, so 24 years. In fact, let's can we get 2025 because we just started? Okay, so 14 years or whatever. We're investing $10,000 as the starting point, and what we're gonna do is basically put every single stock in here, put all the basically the 10% each, so basically diversified and divided equally when it comes to the weighting side of things. And then what we're going to do is look at how much we would invest. So 10,000 without reinvesting anything else. Right now you would have 274. So in 2000, if you invested in these 10 companies and left them alone without adding a penny, okay, so your initial investment was 10,000. Right now you will have 274,000 pounds or dollars, whichever. Okay, that's about 24% CAGR. Really good. Now watch this. If we go back here and we say, okay, we're gonna make contribution. So we've been working all these 5 years, right? We're gonna basically put $1,000 every single month, and we're gonna reinvest our dividends every single month. Okay, let's see what we come up with. Okay, $2 million, 41% CAGR, which is absolutely ridiculous. From 274 to over 2 million US dollars, because we are inputting money into the market every single month, £1,000 for 24 years. So if you're sitting around right now in your 20s, okay, or you're 18, 19, in your 20s, by the time you're 45, you could be a millionaire if you find the right companies and hold them for the long run and ignore this noise that happens on daily basis. This is genuinely a noise, because these companies, I'll show you why they're noise, and just a basic noise. If you look at for the 1 year performance, okay, look at Nvidia, over 95% up. Okay, look at the rest of these companies. Every single company that's done a lot today basically has more or less been going basically up every single week. So this one is up over 344%. So just ignore the noise, focus on your long-term goals, focus on these companies that are high quality businesses, okay, and hold them for a very, very long time. And that's what I wanted to share with you guys today. I'm going to quickly show you Sharia compliance side of things, so you have the full picture. Okay, that is the Sharia compliance side of things. And if anyone ever tells you basically dividend stocks don't do whatever, then just basically do not listen. Just find high quality businesses and buy them and hold them for a very long time. Again, please do your research. I'm doing everything I can to basically help the community, but you also need to do your part, inshallah. If you own any of the companies that we talked about today, or you're about to buy it or whatever, put it in the comment section. Let me know what you think. Let me know what you think about this entire portfolio. Do you agree? Do you disagree? Do you hate this? Whatever. Just let me know, inshallah, what you think about it. Have a wonderful day. Assalamu Alaikum.